Hi guys, thanks for tuning in to another episode of Nuggets News, or our regular monthly update with our friend Martin North. How are you going, Martin?
Pretty good. How are you?
Good, thanks. Did you have a good Easter break?
Yeah, too short, of course, but actually very pleasant. How about you?
It was great. It was great to take a few days off, and the weather was awesome down in Tassie. So we're going to jump in and have a look at our top 10 data points on how the housing market and economy is tracking in Australia. And it's been another very interesting month, and I've read a lot of mainstream articles saying that the bottom's in and that we're recovering and we're seeing strong auction rates. So I'm sure we'll touch on all that as well.
Yeah, that's funny, isn't it? How the slightest upturn, everybody's suddenly saying it's all going to be wonderful again, and the sun's going to come out, and property prices are going to bounce, and everything's wonderful. And I wish it was that straightforward.
Yeah, and there's actually been a bit of heat exchanged on Twitter between John Adams and a few of the other guys, and it's really fiery now, and I haven't really noticed that before. So there's some strong opinions both ways about what's going to happen.
Well, I think so, because a lot of the people on Twitter are very opinionated. But the question is, you've got to ask the question, what's driving their particular point of view? Do they have an agenda? Who are they associated with? Are they being objective? And all of those things, I think, are coming to the fore. And effectively, what John and I are saying is, when you actually hear a piece of information, just don't take it as a gospel. Ask who's producing it, why they're saying it, and what their true agenda is. Because frankly, there are a lot of people wanting to talk the market up just for the sake of talking the market up.
It's a lot worse in my university and crypto Twitter, Martin, as well. So maybe the housing market's going to get to that stage as well. But the other thing I wanted to ask you about was, congratulations on getting on some more mainstream stuff, but do you tend to find that they put your point of view forward, but then they tend to spin it as the always showing the other side and sort of not really saying that this is the base case? They're just sort of making us look like the outside opinion still.
Well, there is a bit of that. So, I do quite a lot of mainstream media, and essentially they want to sort of narrow in on a little bit of the puzzle. And so, for example, I did something on 7:30 relating to negative equity, and they gave me a little bit of a focus, and I shared some of my data. But they also want to counterpoint it with other views and other opinions. And in some cases, it's clear to me that they're a little bit nervous about the fact that my views are a little bit more, let's say, way out there. In other words, negative equity is high. There are more risks compared with what other people are saying. So, yeah, quite often mainstream media does temper the opinions and views. And I guess some of that's natural. They want to find a middle way. But I think sometimes they do miss the key points and key themes until way too late as a result.
And negative equity isn't one of our slides today, is it?
No, we're not going to talk about negative equity specifically today, because that's going to take a longer conversation. We could have a separate discussion about it if you want.
Sure,
but
yeah.
It is actually pretty important because, of course, as prices fall, more people discover that their mortgages are now higher value than the value of the property, which means that, of course, they can't. If they sold, they'd still have a loan. So that's a bit of a problem.
Yeah, and I'd encourage everyone to watch that video you did about that recently. But I think we're getting to that point where the banks are going to have to maybe mark to the new market value, which is down 20% in a lot of suburbs and whatnot. So that's when things get interesting. But let's dive in and have a look at the charts you've got for us today.
All right. Okay. Well, we'll just switch across and go through some of the slides. Okay.
Fantastic. So that's all working, and we've got housing credit, and it's still growing at 4.2%, which is not what you'd think in the mainstream.
Yeah, it's very interesting, isn't it? So this is for the latest RBA data, and it shows that despite all of the bad news and everything else, overall credit is still growing at more than 4%, and owner-occupied housing credit is still growing at 5.9%. It's investor credit that's really gone off the boil. And what that essentially means is that despite all of the hype about, there's no lending and there's no, there is still stronger credit relative to incomes, which means that households are getting more and more into debt, even at these levels. And that's something to bear in mind when you start hearing people about saying, well, the banks should be dialing back their lending standards, et cetera, et cetera. The fact is, credit is still growing very, very fast.
And if we take a step back and say, well, housing's now down 10 to 20% in a lot of suburbs, and this is at a time when credit is still growing, and that's the most important thing. We talk about that credit impulse and the rate of growth a lot. So if that actually slows down or rolls over, and we've already had a 20% correction, that's when we can get some of those more nasty scenarios.
Well, that's right. So there are two factors. Firstly, what is the value of property doing? So if property prices are, say, 20 to 25% down in some places, that means that many people will be in negative equity. But it also suggests that people are still getting loans today. And in many cases, those loans are still quite extended. So people are extending themselves because of the current low interest rates, because they still want to get into property or they want to refinance, all those sorts of things. But the overall amount of debt in the economy is continuing to build, and that creates more risks later.
Fantastic. What have we got up next, Martin?
Okay, so let's flick over to the next one. So this is about new lending flows. Now, this is trying to get at essentially saying, let's look not just at the stock of loans, but the new flows that are coming in. And that shows you that over the last 12 months, the loan flows are down 14.2% for owner occupation. They're down 28.9% for investment flows. You can see that it's the investment sector that has really gone off the boil. And that personal finance is down a little, and all households, their borrowing is down 17.9% compared with a year ago. So this is the new loans coming on stream, right? Now, you need to contrast this slide with the previous one that says that total lending is still growing, but new loans relative to the portfolio are actually dropping. And it's this track here which tells you all about the credit impulse. So this shows you that the amount of new loans being written continues to drop.
And as we discussed in our documentary, that investment lending got to 40% at one stage. And that whipsaw we see there with that yellow line, is that to do with the rules and the limitations that were put in place and then unwound?
Yeah, so some of it's to do with tighter lending standards, and particularly from APRA, and then of course the banks, did their own tightening, but also a lack of demand as well. So property investors are saying, why would I invest in property when the value of my potential investment is going to go backwards? So demand is also significantly down, and demand from overseas borrowers as well. So it's a demand and a supply issue, but it actually all comes back to the credit impulse. And this probably is the key slide to watch. If you start seeing some of these flows move upwards, well, then maybe you could then say that things are beginning to improve. But frankly, until that happens, it's more on the downside, I think.
And Martin, do you have much data on what percent of that investment lending is from foreigners? Because I did read that foreigners were 40% of new mortgages only, I think it was 2 years ago, and that has dropped to 10%. So that's a huge fall from foreign investment.
Yeah, it's actually even lower than that now. And the latest data from NAB suggests it could be less than 8%, and it's continuing to drop. That's because China's really tightened up their rules and regs with regards to international investing. They're trying to repopulate capital back into China because of the issues there. So, yeah, the number of international investors are really just falling off the cliff.
Fantastic. What have we got up next, Martin?
Okay, well, just to finish off, that's the business one. So even business lending is down, so it's pretty much across the board. Then let's talk about household confidence. So this is, of course, my proprietary data, looking at what households are doing and how they're feeling about their finances. And what's interesting about this, if you follow the trends, is that we had a bit of an uptick 2006, 2007, but since then it's been trending down. And so the overall index is well below 100. Those renting and those mortgaged are well below 100. But what's also interesting is even those without a mortgage, so these are what I call the free affluents, they've now got to the point where their confidence level is below the neutral setting. Now, that's quite important with regard to the upcoming election, because a lot of those people would be probably more on the conservative side of politics. So what it tells me is that even many of those people are actually now worried about their own finances and the state of things. And that's to do with incomes not growing. That's to do with all the other things that we talk about. So I think generally household financial confidence continues to slide.
And that peak that we see is very much a case of housing prices were near their tops. It's that seasonal time of year where we're all pretty happy and confident, and it's just been nothing but downhill for 2 years now.
Well, I think that's right. 18 months to 2 years. And, the point that I keep making is we shouldn't think of this as necessarily just a little blip and then a correction. I think this is going to be the continuation of a trend that we're going to see for quite some time yet.
Yeah, and I tend to agree that it's that slow grind. It doesn't have to be a sharp fall. I mean, house prices have already gone down 20%, and at no point has there been any panic at this stage. It's just every month we get the data and it's ticked down another percent or so.
Yes, and all the other economists are continuing to forecast on the downside. Moody's came out this last week with a more negative forecast, and other people too. So slowly but surely, some of the mainstream are beginning to catch on that this is not going to be just a little blip. This is going to be a significant blip.
It's funny that some of the rating agencies, even the overseas ones that may have big short positions on our banks, are far more likely to say things are going to get bad, whereas the locally, where their job is to keep everyone upbeat and confident, they're probably less likely to say that things are going to get bad.
Well, that's of course always the question. It goes back to what I said earlier on. When somebody's talking about a particular data point, what is their objective? What is their agenda? Because everybody will have some sort of agenda. I mean, I try to be objective and independent because I've got no axe to grind at all. But many other people will be actually thinking about the context of what they're saying and, where they fit in the overall scheme of things. So that's something to bear in mind.
Yeah, great advice. What have we got up next, Martin?
Okay, so now this is the mortgage stress chart. This is, of course, the one I run each month. And this shows you that now we've got 13.6% of households in mortgage stress. So this is on a cash flow basis, money in, money out. So people are struggling with those mortgages and making those repayments because they've got big mortgages. And even with low interest rates, the repayments are quite high. But also, of course, the cost of living continue to rise dramatically higher than income-led growth. And it just puts more pressure on households. And this is something that's pretty intractable now. More than 1 million households are in difficulty. So this is one of the key reasons why household expenditure continues to dive, why people are raiding savings, and why people are struggling. And it's also worth just highlighting the Reserve Bank's latest data also is 189.6. So that's the debt to disposable income ratio. That's really, really high on an international basis. So it goes back to my point about the fact that household debt is horribly high in Australia.
Yeah, that mortgage stress number is lower with some other data sets that I've read as well. And do you want to talk about how that compares to the GFC and to maybe Ireland, what we saw there with household stress?
Yeah, so obviously I measure mortgage stress in a particular way, which is looking on a cash flow basis. A lot of people don't do that. A lot of people look at 30% of income. If people are more than 30% of income on servicing the mortgage, then they're in difficulty. We know that in Ireland, the ratio was somewhat lower than this when effectively everything happened. And the Reserve Bank came out a couple of weeks ago and said that around 30% of households with a mortgage have no buffer at all. That's interesting. So they come up with 30%. I'm saying 31%. So it suggests to me that perhaps these figures are more robust and more realistic than many would prefer to see.
Fantastic. Yeah.
Okay, just on bank funding, this is very interesting because I think when we spoke last month, we were saying that the BBSW, which is effectively an indication of bank funding, was still very extended, but it's completely reversed now. So we've now got a minus 8.3 basis point gap between where it was a year ago and now. And this is really interesting because what it's allowing the banks to do is to offer very, very cheap mortgages, particularly fixed rate mortgages, 2 years and 3 years for refinancing of good credit. So there's a big competition going on to try and grab those borrowers because essentially they are really the only game in town. And what this tells me is that we're going to see continued pressure on the banks. And in fact, all the results that we're going to see in the next little while will all be about margin compression. So effectively what they're doing is using the lower BBSW rate to try and entice low risk refinancing. Many other people will still find that those mortgages are still very high and those rates are not going to come down. So it's quite an interesting change in the weather.
Yeah, how do you see the overseas bank sentiment if this starts to get a bit worse? Is that going to tick up again, and how does that affect our local banks? Because as you say now, they've got a bit more money to play around with.
Yeah, I think the question is what's going to happen on the international financial markets. The Fed is basically saying they're more likely to cut rates ahead rather than lift rates, which is the big change. We've also got Brexit and China and other international uncertainties. So my view is that the chances are we're going to see funding costs ease a little, but then I think probably begin to come up again because as risks in the system continue to grow, and I'm thinking of growth being slower, and I'm thinking of some of those other international issues that are bubbling on at the moment, like the trade issues with China, for example. It could well be that funding then starts to rise again. So it's important to watch the BBSW because it's a really good forward indicator of what may be happening. But I don't think it's the only indicator that we should be watching.
Yeah, I talk a lot on my channel about how the Fed really controls the markets too much these days, and you can clearly see that point in the end of December there where Jerome Powell started telling people that interest rates aren't going to be at 3.5% in the US in a year's time anymore, and you can see the banks go, oh, hold on, well, all of a sudden Australia looks a little bit more attractive if we're not going to get such a high rate in the US, and more money has crept back into the Australian banks.
Well, that's true, but bond rates in the US are still better than here, so international investors are still preferring the US to Australia even now.
I guess it's all relevant, isn't it, Martin? Yeah.
It is. It's all relative. Yeah. Okay. Now, just in terms of home price falls, this is the CoreLogic series, which just makes the point that over the last year, prices have fallen now by more than 10%. So that's a really big fall. But it doesn't necessarily reflect everywhere. So we're looking here at the upper quartile versus the lower quartile. In other words, cheaper properties haven't fallen as much as more expensive properties. And also it shows you that it's in the combined capital cities, particularly Sydney, Melbourne, relative to the regional areas. And interestingly, if you look at Canberra and Hobart, you'll see that there, over the last little while, there's still growth. So it's really interesting, and it's important to get granular around some of these factors, because essentially if you take the high level data, essentially all you get is just averaging, which doesn't tell you much. The truth is that there are pockets where prices are down 20 to 25%. There are also pockets where prices are down much lower than that, and in some cases, in some markets, are still, over the last 12 months, higher. So it's really important to get close to the local data rather than just high-level averaging. But nevertheless, this is a concerning trend, because this tells you that prices are still down and look to me to be falling further.
Yeah, and if you go further out into the suburbs in that lower quartile, it tends to be more likely, more statistically speaking, that it's the average person that bought a mortgage, whereas the further we go into the city, we get more into that speculation, the investors, the foreign buyers, and all the apartments that came online, and that's why they have further to fall.
That's true. And if you look at the low quartile in Sydney, that's nearly 9%. In Perth, it's down 8%. Darwin down 10%. A lot of that is, as you say, in the apartment sector, which is really taking a bath at the moment.
Fantastic.
Okay, and then just on the underemployment and unemployment. So there was, the ABS came out with their employment data, and there was a slight uptick in the seasonally adjusted number. It went from 4.9 to 5%. But what's really interesting, and we discussed the Roy Morgan data set as well, because that's a different way of looking at the data. And both Roy Morgan and the ABS is showing that underemployment continues to rise. So that tells you, and as we discussed this, I think, in more detail recently, that if you've got 1 hour of employment, you're regarded as employed, right? So there are a lot of people looking for work or haven't got enough work, and it's the underemployment number which I think we should be looking at. So Roy Morgan is basically saying that the combination of unemployment and underemployment has shot up to 20.6%, and the ABS unemployment and underemployment to 13%. These are really big numbers, and it explains some of the weakness that we see in the economy, because there are many people who are essentially struggling with a lot of these issues.
Yeah, and I'll link to those two videos. So I want everyone to watch that video we did about employment, how it's calculated, and one about negative interest rates and the war on cash that's really starting to heat up, and some of the IMF stuff that's come out recently. But I think the other numbers I read were some of the sectors, architecture, construction, manufacturing, are down like 20% now. And you can... this is looking under the hood rather than these sort of fudge numbers saying that unemployment's never been greater. And I think that we've seen the bottom. I think unemployment has only got room to trend higher, but maybe I'm wrong.
No, I think you probably are right. It's early days, of course, because of this number, comes out every month, and we're just watching this uptick. So I should be very interested to see what it's going to be in 6 months' time. And if it does start to trend up, then expect mortgage stress to continue to build. Expect household confidence to continue to waver, and expect lending growth to continue to slide. So these could be very important indicators with regard to the future direction of the economy. And I keep coming back to the fact that we've got so many people with some work, but not enough work. They want more work and can't get it. And that really, for me, is the soft underbelly of what the unemployment number should be about.
And this has certainly been one that the RBA and politicians have hung their hat on. And I think if this was to start to trend higher, they don't really have anything else to sort of clutch at then.
Well, unfortunately, it is, the number of new jobs is the one that's always quoted. A lot of those jobs may be part-time Uber-type jobs. And it really doesn't tell you the full story. You need to take more triangulation points on the data to really understand what's going on.
Exactly, yeah.
And just on the budget, it's worth just reflecting on 2 points. The first is that if you look at what happened, basically a lot of the federal spending is out there in Never Never Land. It's not really in the next 2 or 3 years, and there's a lot of fudging going on in the later numbers. In fact, the Grattan Institute highlighted the fact that there was 40 billion of cuts hidden in the budget in the out years, because you don't have to be too specific about that, and there are various other funnies in the budget numbers. So basically, don't take the budget with too much seriousness, because there's a whole bunch of stuff going on there. And just on the other side of it, thinking of the budget, this is looking at the wage growth forecast. Now, I keep coming back to wage growth because wage growth is the most critical question. But in the budget, they've got this view that, in a couple of years' time, we're going to see wage growth at 3.5%. But if you go back over the last few years, you can see that pretty much every forecast on wages growth was wrong, and they always got it wrong on the upside, and that was always worse. So I'm expecting it to be lower ahead as well.
This is one that really grinds my gears, Martin. The accuracy of a kindergarten weatherman, I say. And every year they tell us that it's going to be great. It's going to get back to 3.5%. Things are going to be rosy. And every single year they're wrong. You can't have a more inaccurate track record, but yet they continue to tell us it's going to get better next year.
Yeah, well, don't believe everything you see in the budget is what I'd say. So it is important to understand that wages growth is critical, but I don't see anything to see it turning around. So there you go. That's the 10 slides. I'll drop back.
Any final thoughts, Martin, on what you're seeing in the mainstream and the sort of opinions and any big data or things we're waiting on in the next month?
Yeah, well, I think that there are a few quite important pieces of information. Of course, the election is sort of, messing the waters, as it were, a little bit. But I'll be looking for the next RBA numbers out in a couple of weeks. It'll be interesting to see what credit is doing. And then we've got some further data a little bit later with regard to more unemployment data or employment data and some of the other data. I'm also going to look for the next home price series when that comes out, because I think we might see some interesting trends there as well. So this is a really dynamic situation, but frankly, if you look at all this data in the round, more on the downside, I think, than not.
And we've had some great prices for our resources, which has really helped Australia, particularly with that surplus recently. And China came out and said we're still growing at 6.5%. So if we look at a lot of other numbers we've covered, like chip manufacturing and phone sales, a lot of these things are starting to tick down in a number of countries now. And I still think that we're being fed these fudge numbers. So we're going to see the real numbers soon.
Well, I think, the 6.4%, which is what China came out with last, was, some would say, optimistic, but they're doing a big stimulation thing. The question is how much of that stimulation will hit the consumer sector in China versus the imports and exports. And as you say, at the moment, our iron ore price is massively high thanks to Brazil stopping production, essentially. So that's not necessarily something which is there for the long term. So, there are some risks building, I think.
Yeah, and the Fed have talked about backing off their tightening, and I think we're going to get another easing cycle. And in Europe, we're already hearing that they're going to be accommodative. In China, as you say, they're pumping billions of dollars every month into the markets. Do you think Australia's going to take the same path, or they're going to do something slightly differently? And do you think for the first time that this is sort of a thesis that I'm building, it's not going to be people aren't going to accept this. They're going to say, no, QE4 is going to result in more inequality. And if we get this in Australia, people are going to say, no, we don't want this. It doesn't work in other countries.
I think that people will, if they're offered cash, they'll take the cash. And I expect a similar process to the GFC and post the GFC. So there'll be seagull payments, coming down from government. There will be, money and largesse flowing to try and stimulate things. Frankly, I think greed will win. So I'm still expecting some sort of QE type process, but it may not be quite the same as the Fed used.
Fantastic. Well, thanks for joining us today, Martin. It's always a pleasure, and we'll talk again soon.
Good to talk to you once again.
Thanks, guys.